What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Research Survey. In this week's episode, we have a special guest joining us for an important discussion. As always, I'll be here with my partner, Stephen Gregory, who leads the quantitative research effort at Piper Sandler. We're thrilled to welcome Don Schneider, Deputy Head of U.S. Policy Research at Piper Sandler, for a deep dive into one of the biggest questions facing investors in 2025. How will President Trump's policy agenda shape the economy and financial markets? Don brings a wealth of policy expertise to the conversation. He previously served as Chief Economist for the House Ways and Means Committee under Chairman Kevin Brady and Paul Ryan, playing a key role in shaping the 2017 Tax Cuts and Jobs Act. Before that, he was an economist and budget analyst for Chairman Ryan on the House Budget Committee. Let's get started.
Don, it's got to be a super exciting time to be in the policy research world.
Yeah, I've basically never been this busy. It feels one thing after another. We're processing some executive order and before I'm even done writing the report about it, I've got another to look at. So very busy.
Are you sleeping at all, Don? I feel like some of these announcements are coming in the middle of the night.
I am sleeping. I guess if I resent anything, it was just the announcements right before Thanksgiving and Christmas. So there's really never an opportunity to tune any of this out. But it's good to be busy.
It's pretty incredible. Some of the news sites have gone to blog format where they're just scrolling through the news as it comes out because it's coming so fast.
Yes, processing headlines and potentially a lot of conflicting executive orders that kind of don't really make sense. So one of Trump's executive orders was just rescinded, and there's questions: was it even necessary in the first place? Is it still live? Yes, it's a fun and challenging time to be in U.S. policy research.
Stephen and I have been working together for 20 years, and we've been working with you a while as well. And if we haven't made it all evident already, we're going to be leaning on you a lot this year to help us process the unknowns and exogenous issues that comes with a new administration and a new policy and a lot of uncertainty.
We're all counting on you.
Yeah. Well, there's a lot of it. Maybe I just start with thinking about the economic impact, and that can drive market impact. But of course, there's big macro themes and sector themes. But from a high level, there are four major policy drivers of growth. And those are kind of tax and fiscal is one, trade policy, regulatory policy, and immigration. And really, for three of the four of those, they're solely up to Trump's discretion, or mostly in his discretion: regulatory policy, trade, and immigration. Over the years, Congress has punted a lot of that authority to the executive branch. So I think that means a number of things, that the kind of Trump has carte blanche. He feels he has a mandate to do what he wants to do, and he has the power to do it. And a lot of those things, they cut both ways. Trade is not a pro-growth item. Immigration policy and shrinking the labor force will have major economic implications. So markets don't really deem that to be a pro-growth thing, even if it's a law and order type of issue. And regulatory policy, I think markets lean on to be a major driver of growth in animal spirits, so that they cut both directions. And then on the fiscal front, it's a much more complicated backdrop with people taking very different views on whether deficits are stimulative or whether they're crowding out investment, driving rates higher. And we are entering this kind of brand new world of kind of permanent 7% of GDP deficits. There's a big debate about whether those deficits are sustainable or not, and at what point they need to shrink. That's a high level framework for what I'm thinking about and how policy affects the economy.
Yeah, I think I realized, and certainly a lot of investors realized or came to appreciate in the last few years after COVID, how influential fiscal policy can be for the economy and thus the stock market when it is as large and in your face as it has been. And so I think we all have to rethink our models and understand how we can incorporate some of these things that weren't necessarily as important or as market moving as they are today. What kind of questions are you getting from clients to help them think about what are the levers that are going to be moving around with all these announcements, and ultimately how they should be thinking about the impact?
I'd say the bulk of the questions really relate to the major fiscal policy or budget reconciliation legislation that Congress is working on. And the goal is to pass that major law by, say, early May. I was lucky enough to be a part of the last major Republican 2017 tax reforms, their reconciliation efforts. I've seen this process unfold before. And this time it's much bigger than when we did it in a certain way, because we had tax reform, which was both individual and corporate side. Now they have to extend the individual tax reforms. They're thinking about what new cuts do we add? Are they for individuals or corporations? How do we reconcile the need to extend existing tax policy with massive deficits that are now on the horizon? I think when we cut taxes, deficits were something like 3% of GDP. Now they're 7% of GDP. In fact, the debt to GDP ratio is over 100. They have to square just the tax piece with that broader fiscal context. And on top of that, they're looking at up to 100 billion in border security funding, 125 billion or so in defense funding, energy policy, looking at their debt limit. So I'd say the bulk of client questions are really focused on what is included in that bill. I'd say the other segment of questions, it gets much harder to predict what is going to happen on trade. And like I said at the outset, where 3 of the 4 key issues are in Trump's hands, on trade policy, it's a fool's errand to try and predict what Trump is going to do and when. We've been focused on not necessarily the process, but the destination of where we're going on trade policy. I would say over the past couple of weeks, I've spent a ton of time looking at the reconciliation outlook, approximately on trade, what's going to happen with this 25% tariff threat on Canada and Mexico, the 10% on China. Is that going to happen on February 1? And how to think about the broader unfolding of the trade war. And then, of course, Trump's executive actions. Those are the big ones that I've been processing the last week or so.
Yeah. So do you think that Trump's been in office for almost 2 weeks now? He's gotten a lot done already. The nominations, those are taking place, a lot of executive actions. What does, in terms of the timing of the roadmap, look like? Are we going to be able to deal with one of these big issues at a time, or are they going to severely overlap in 2025? What does that look like to you?
There's huge overlap of them. Maybe you can put things into 4 different buckets timing wise. One is the kind of nominations process, and that is well underway. 2 key people have already been confirmed. That's going to proceed ahead. That's not a huge story. There's some questions about whether RFK gets confirmed and Tulsi Gabbard and a few others. But the 3 major ones to think about that are happening alongside each other. One is the budget kind of reconciliation process, where you actually are able to legislate Trump's agenda. The other is debt limit and routine funding of the government. We have a deadline on March 14th. So if we would shut down if we haven't funded the government by then. But in addition to funding the government, which again is only till September 30th, we've got to do it all over again. And we have to deal with disaster relief for California. So there's going to be more than 100 billion in damages. That's going to need federal relief. And there's the debt limit. So I'd say on one column, I would think about we have our first deadline in March, another September 30 for the funding the government. And in between there, sometime in July or August, we will exhaust all of our cash on hand in the Treasury General account, and we would experience a technical default if the debt limit were not raised. So Congress is thinking of maybe we deal with that in June. On the separate track, we've got the budget reconciliation process, enacting Trump's agenda, that sweeping package of defense, immigration, energy, tax policy. That the goal for Republicans, they're in the midst of a debate. Do we do 1 bill or 2 bills? If you do 1 bill, that probably ensures the best probability of passage, because if you lump it all together, it makes it hard for people to vote against it. If you separate it, then people might be sad. Let's say you pulled out the border security stuff. You would lose members who are only in it for that on, say, the tax piece that happens later. So the goal is to get that done by May. In theory, this process could kick off next week with the release of a budget resolution. So we now have kind of key dates on the budget side in mid-March, June, September 30. On the budget reconciliation package, that could start as early as February and end as early as May. And we think it probably best case scenario is completed by July. And then in this third column, you have trade policy, potentially, tariffs enacted on China, Canada, Mexico on February 1. And April 1 is the deadline for the review, comprehensive review, everything in the executive branch, all of the trade authorities, all the potential ways in which the U.S. is being harmed by trade. And in that case, when that review is concluded, Trump is going to proceed with his broader tariff strategy.
So you mentioned a lot of dates there with the debt limit and then the technical default in August. So that's an interesting one. How big are those fights going to be? Or is this going to be just once again right down to the deadline on all of these?
I think so. In general, Congress doesn't really do a good job of acting until they have a deadline to force their hand. I guess we could start with the debt limit piece of it and then go to the others. How does their action relate to the deadline? The Treasury has started on January 2, 700 billion in cash on hand. They have about another 300 billion in extraordinary measures. How long does it take them to drain $1 trillion? So you're going to spend a lot of money in February as you pay out tax refunds. Tax receipts come in April, and then we run structural kind of $2 trillion a year deficits. So that drain proceeds thereafter, and probably in August you wouldn't have enough cash on hand to meet all obligations in a day. So that's what a technical default is. They would cover principal and interest payments, and so we wouldn't have a sovereign default. It would be a technical default. I don't think we're ever going to get there. So Congress needs to act first to raise the limit. There's a few ways that can happen, maybe four. So one is Republicans are debating, do we include this in our budget reconciliation bill so we never need to work with Democrats? Historically, it never works this way. It's always a bipartisan vote because there are always Republicans who refuse to vote for it. They consider it a very politically damaging vote where they have to basically authorize new debt. And so it's always been challenging for them to vote for it. Trump has said, and this was in a lame duck session, basically he wants to raise the limit for the duration of his term so he never has to deal with it, or eliminate it entirely. Republicans have no interest in eliminating the limit entirely because they view it as kind of the one check we have per year to force a discussion about our debt. So I don't see Republicans dealing with it on a party line basis. I also think it's going to be challenging to deal with this in March because we don't have the kind of real threat or deadline forcing action. There's been some talk about maybe we couple the debt limit with the government funding bill or disaster relief for California. But I think Democrats have realized, based on Trump's own demands and interest in terminating the debt limit, that Republicans need this done badly for them. They can't do it themselves, so they shouldn't offer a vote to raise the limit for free, so to speak. And they're going to make Republicans pay a price for it. And so I think what that means is we're not going to see action on the debt limit in March or anything like that. We're probably going to need a bipartisan deal, and that will probably happen sometime in June or July. And it comes down to the wire, and we have a real deadline to do so.
Does the Doge committee, the introduction of that, does that potentially exasperate things, help things? Is it a non-event?
Yeah, Doge was created now by executive action on Trump's first day. Vivek is now out, so it's up to Elon. And it's not really clear how broad their authority really is. At least the way it was described in the executive order, it's mainly about implementing better software systems and AI into government, which is much, much narrower in scope than it was initially envisioned. I think maybe it's not helpful to think of what is Doge's authority, which is really what will the executive branch do without Congress to control spending. And I think there's four real ways that they can go about that. One is firing federal workers. There's about $240 billion that we spend per year on federal salaries. We've already seen some news flow on that with Trump offering buyouts to workers and then firing DEI-related workers. Second, there's just cutting out waste, fraud, and abuse in government programs. For example, there's $170 billion in what are considered improper payments per year. Can you do anything, whether it be with AI or just general good governance, solve that fraud? But this fraud or this improper payments has been with us for some time, and the solutions in one program are very different than the solutions in another. The third category is renegotiating federal contracts or not paying them. And in this case, there's a few different ways to go about it. In the Department of Defense world, you could introduce more competition into the contracting process, shift more contracts to a fixed cost rather than a cost plus basis. Those are some of the ideas on the table. So there is some debate about renegotiating those contracts, renegotiating IT contracts, doing it as a whole federal government.
Has anything like that ever been attempted?
Not to my knowledge, really. A lot of this is dictated by Congress. Congress has power over the first of this. They spend on this, and then the executive branch executes to go carry out those demands. So this does, I think, necessarily set up a fight with Congress if you have the executive branch not just trying to make sure the payments are spent in the most efficient manner, but basically picking and choosing or disagreeing with Congress on where the money goes. And I guess I should say I left out what kind of the single largest category for savings from Doge, which is what they call regulatory rescissions or executive actions. The executive branch is not really supposed to be making decisions on their own that impact the budget. So Biden tried this. He tried to cancel student loan debt in a broad way. The courts checked him. There are lots of other ways that Trump administration, whether it be recommendations from DOGE or what Trump wants to do on his own, there's over $1 trillion in executive actions, $1 trillion over a decade in executive actions that Trump could roll back if he wants to. And he probably will, a mix of him and Congress. So I think there are savings that we will see the Trump administration take or Congress will take. Whether we attribute those to DOGE or something else is another thing. But yeah, I think DOGE will play an important role, and so will Elon in what the administration does.
Now, you mentioned how things have gotten caught up in the courts before. How much of the administration plan could just go into legal quagmire? Where are the potential landmines?
We saw that yesterday. And so Trump said or the Trump administration released a memo that looked like it was going to put a freeze on all federal grants. And it wasn't clear how broadly it was going to apply. There was legal action taken on that very same day, and there was a stay put on the implementation of that freeze for a few days. So that's an obvious case where it's a debate over power of the purse. Another, probably the most important legal debate, I think will play out when it comes to tariffs. Trump has tons of legal authority to implement tariffs without Congress. Congress, over the years, has fronted that legal authority to the executive branch in hopes that it would liberalize trade, make it easier to lower trade barriers and tariffs. But Trump can use that authority to do the opposite. He already did that in the case of China, where there was an investigation that concluded China was stealing IP from American companies. That was our harm. We used that to seek remedies. We raised tariffs on China. The big legal debate is if Trump wants to broaden this effort out to a universal tariff, which he keeps talking about, 10% universal. They said 20%. We've seen ideas pitched like maybe we do a zero rate on our allies, 5% on people countries who are in between, maybe India, and 10% on China or other countries who are perceived as cheating us the most. And that's where the legal question really comes in. Does Trump have the authority to basically declare a national security emergency that's so broad that he could then levy tariffs on all of our trading partners? So we do expect a lot of this action to get caught up in the courts, but the administration seems eager for the fight.
Would you say that tariffs are going to be his number one weapon? We saw last week when President of Colombia didn't allow a plane landed with folks that were deported, boom, tariff. And then problem solved. Are we going to see a lot of this throughout the year or in Trump's term, incrementally as a kind of a policy weapon?
Yeah, absolutely. Howard Lutnick testifying, from the Commerce Committee, and he had made some comments about how, look, what we're doing or what we're talking about today with respect to China or Canada and Mexico, these are correct where we're trying to change behavior. And what comes later is really a methodical approach we're going to take. So I think when it comes to, say, in the case of Colombia or Mexico, Canada, Trump has made threats that if you don't stop sending fentanyl into the country or you don't stop illegal immigration, you are going to face tariffs. Or in the case of Colombia, if you're unwilling to take deported illegal immigrants, then not only are you going to be faced with tariffs, you're going to face other sanctions as well. Those are kind of rifle shot measures intended to affect other outcomes other than just affecting trade deficits or trade policy per se. There will come other cases where Trump is going to take this more methodical approach. Why do we have a trade deficit with you? And we use tariffs either as a weapon to change that behavior or just because, like in the case of China, I think there's going to be a push to decouple for the sake of decoupling, that we just shouldn't be this reliant on Chinese production for critical products like pharmaceuticals and things like that.
Yeah, and you guys have written and made the case that Trump's going to be, like you said in the beginning of this discussion, that you're looking at the end point, not necessarily the path, and that the end point for Trump on tariffs, particularly with China, is going to be aggressive, which if for an investor, we've had all these headlines from Trump all over the map with China from his presidential run, where he was very aggressive, to a week or so ago, he talked about, maybe I don't want to do tariffs. And so I think we're all conditioned now to expect kind of this ramp up in volume and then maybe a quieting down and until we get some definitive answers. But can you talk a little bit about, again, where you see the endpoints for tariffs? Because I think you guys have a good amount of conviction that the investment community is really underpricing the risk around there and really paying more attention to what Trump is saying in the near term and not focusing on the end goal?
Yeah. So I think investors, are already doubting how far Trump was really going to go. And some of that is, so I think, investors just take or would he do something bad for the market kind of thing. That's, of course,
Yeah.
not how he thinks. He does care about the market, but he does have longstanding views on China being a threat to the United States. And of course, looks at trade deficits as a harm to the US, that is zero sum step in effect. So, say, taking the longer view on China, what has happened since 2018 when Trump first implemented tariffs on China? Then he was really fixated on getting a phase one deal, as he called it, which is threaten you with tariffs, stealing our IP. So we're going to threaten you with tariffs. And what we want from you is purchasing our oil, our soybeans, agriculture products, et cetera. Let's get this trade deficit down. They never honored the agreement. In the interim, Hong Kong and COVID have happened. So there's no real trust that they're going to live up to the terms of an agreement. And COVID and Hong Kong have only further cemented, I think, the Trump administration's view that China is a threat to the United States that can't be trusted. So I think the barrier or the hurdle to a deal is much higher than it was before. It's still clear that Trump is looking for some kind of deal making, some kind of leverage. He talks about like why he won't ban TikTok. He wants to use that as leverage in these talks. He is still talking about purchase commitments and making sure China lives up to the phase one agreement. But I think our point about look at the destination. What can China offer with a kind of gun to their head, so to speak? Are they really willing to make concessions to the United States? Are they willing to stop the theft of intellectual property? Do they want to their arm twisted in this way? So I don't think that there's really much that they're going to be willing to concede to Trump. And then you have the true hardliners in Trump's camp from Nair to Navarro who want to see this decoupling happen, if not for not every product perhaps, but for things like pharmaceuticals. That's a big risk if China controls the entire supply chain, and for all of our munitions, aerospace, being that reliant on China. So for all of those reasons, if there's not much that China can offer Trump other than purchases that they never made in his first term, I just think the destination is going to be significant tightening of tariffs and export controls.
I think it's really interesting. You brought up pharmaceuticals and aerospace and defense. These have been volatile and have traded up in many cases around all of the news. How are investors communicating to you about these topics in a anticipatory way, trying to get ahead of it? Reactionary? What's been the tone with how people that do this for a living are approaching these kind of very fast-paced, high-stakes topics that Trump is rolling out at a record pace?
Yeah, some of it is very much anticipatory, looking at where is their exposure. I feel like we were looking at Yeti, for example, as a company that was going to face risk from tariffs, and then they had ended up moving a lot of its supply chain apparently out of China. So I think people are looking at what is our company's exposure to China, what is the U.S. reliance on it, or is it a product that necessarily isn't under the scope of tariffs, or something that you could. What do we deem necessary for our national defense? Is that next? So people are also looking at step two, which is retaliation. How does China respond to this sort of action? And then, what U.S. products are at risk? Where is this production going to go? Vietnam, they've been beneficiaries a lot of, basically given the rules of origin can be easy to circumvent. So a lot of production is moved into Vietnam, gets sent in the U.S. So they're looking at my production that's now in Vietnam or Mexico, is that at risk too? So I think people are looking many steps ahead to consider exposure to tariff risk.
All right, let's shift gears a little bit. And I want to touch on deregulation. You guys had a phenomenal chart showing the regulatory costs under the various administrations going back to Bush in 2005, and how large the regulatory costs were for Biden, especially when you include the EPA vehicle emissions rule, almost $1 trillion at $870 billion. Can you speak to where are investors focused on, and how those are going to be rolling out over the next several months and quarters?
Yeah. So we compiled some great data from the American Action Forum. So what they do is, when a regulation is finalized, it goes in the Federal Register. Agencies are required to produce a cost analysis of the regulation. So we look at the net present value cost of the regulation and express it as a share of GDP, for example. So in Bush's second term, he added over a 4-year period, about 1% of GDP in regulatory costs. In Obama's 8 years, he added 5% of GDP of regulatory costs. Trump was net zero. He added some, he repealed a bunch of others. So he basically, for the first time ever, restrained growth of the regulatory state. And then Biden's 4 years, he's added 6% of GDP or more in regulatory costs. The vast majority of regulatory burden is environmental. So in terms of what Trump can do on regulatory policy, a lot of it is going to be in the environmental space. I think a mix of how investors are thinking about it is, even when you just change the personnel in an agency, that even if you don't change the rules, they're going to be enforced differently in a more favorable way. You also see expectations of much easier M&A activity, so much more lax antitrust authority in the FTC and the DOJ. And I think where Trump is predominantly concerned is facilitating traditional energy production and rolling back renewable energy production. And an example is those vehicle emissions rules, they're the tailpipe emission rules that you mentioned. Those were, I think, about $880 billion in present value costs put on the private sector, which is, if you set these tailpipe emissions targets that are extremely onerous, internal combustion engine vehicles will never, or make it very difficult for them to comply with those regs. So you end up forcing consumers into electric vehicles. And one of the, of course, there are those costs that are borne by consumers and companies who need to, pay for those vehicles and to produce them. There's also a direct cost to the federal government. We have a $7,500 electric vehicle credit, and at the time, it was estimated that just the cost of forcing consumers into these cars alone would have added about $200 billion to the cost of the EV credit. So those are the types of policies that Trump is going to reverse. And then he has independent actions, I think, to make government more efficient or more pro-growth. Those are the kind of steps he's going to take to change the regulatory environment.
Do you have a sense of where investors are looking to leverage that deregulation idea? You mentioned in the environmental space. Is it the more mid-cap space, or every kind of feel on that?
Well, just from a top-down sense, or where is it expressed? It's in M&A's most predominant. Financials is seen as kind of the biggest beneficiary of. It has real economy effects if they're able to loosen lending standards. Also, that's just a place where credit administration has been particularly onerous or stringent in how the rules are applied. And then in the energy space, it makes people bifurcated in the sense that it helps traditional energy and punishes renewables. So I think that's kind of top-down way to view it. I know in general, regulatory costs, they're fixed costs, and those fall most heavily on kind of mid-cap. So those kind of middle America companies where, the small firms are often exempted from or don't face the same compliance burden. Big companies are able to manage the burden, but as expressed as a fraction of revenues or something, the burden falls most on these mid-level companies. Having said that, I don't know if that's the best way to think about winners and losers. If the bulk of what's happening or what matters is, say, for financials or renewables, and it's more of like a sector-based approach.
Yeah, we've certainly seen the financial sector on fire and back to new all-time highs as Trump's odds of winning the election went up, certainly when he won. And obviously that's more activity from that certainly baked into the estimates going forward there. Is there any part of his regulatory or deregulation goals that is potentially at risk of not being able to do what he wants to do?
I'm not sure where he's most at risk. I mean, in some cases, we've kind of ping-ponged back and forth where Obama implements labor regulations, Trump rescinds them, Biden puts them back on, we rescind them, and you never really get that far. I think Trump was constrained in his first terms by the APA, Administrative Procedures Act, not always pursuing deregulation in like a legally appropriate way and getting hamstrung by the courts. Maybe the biggest ways that his deregulatory efforts are held up is in the permitting space. That Trump talks a lot about he wants to boost energy production. Really, there's not that much the federal government can ultimately do when you have state and local requirements on building out your energy infrastructure. The federal government can clear the way as much as possible, but you can't prevent the state and local requirements. And then importantly, there are federal law that needs to change, that the president just doesn't have the authority over what's known as EPA, these environmental reviews. They take years to produce. So you can try and force the agencies to act more quickly, but there's all kinds of ways that people can file lawsuits and slow down the ability to build out any infrastructure. So I think that's probably the most important way that Trump's kind of deregulatory agenda will be stymied. There's just a certain point where it requires congressional action to do some of the more sweeping things. I do think there's actually a good chance this gets done maybe within the first couple of years of his administration, because for the longest time, Democrats never really had a reason to be in the game of reducing environmental review. That's always been considered sacrosanct to protect it. Now, renewable energy projects can't get their infrastructure built out. So you have this kind of interesting mix of a need for Republicans and Democrats to finally fix our permitting process.
All right, Don, let's shift over to tax policy. This is something, as you pointed out, Trump is going to need to work with Congress, and you guys have highlighted the slim margin and that ultimately Trump is unlikely to get everything he wants in terms of a tax package. So can you talk about what he's looking for, where you guys think it'll end up? And also, I think would be important to remind our listeners of just the cost change that we know today of renewing the existing tax cuts from 2017 from where those estimates were back then, and how that's shifted the likelihood of things going forward.
Okay, so what we did in 2017, the way a budget reconciliation process works, you're given very tight fiscal rules. You're given a target. Our target was we could cut taxes by no more than 1.5 trillion. So we were instructed to add no more than 1.5 trillion to the deficit. That's over a 10-year period. So today, extending those tax cuts is now 4.7 trillion. It's much more expensive in nominal terms to do that. So when we look at what we did back in 2017, it was actually more like 5.5 trillion in tax cuts and 4 trillion in tax increases. That got us to net 1.5 trillion. And we took the corporate rate down from 35% to 21%. We did a lot, and we found ways to make it permanent. So under the rules of this law, or budget reconciliation, how it works, you can't have a permanently deficit increasing policy. So within that 10-year horizon, you can add as much to the debt as your instruction allows. After 10 years, it has to be paid for. So this is what we were able to find a bunch of budgetary offsets, basically other tax increases, and pay for that permanent 21% corporate rate. But all the individual tax cuts, which in the bill were about 1.1 trillion of the 1.5 trillion in cuts, those had to be temporary. They expired after 8 years. Here they are, or they're now expiring. So simply extending out what was then 1.1 trillion in individual tax cuts is now 3.9 trillion over a decade. Some of that, they're more expensive because nominal GDP has grown. I think GDP was something like 19 trillion in 2017, nominal GDP. Now it's 30 trillion. It's going to grow. We have more income, tax cuts cost. But the fact remains that extending all these cuts is about 1.25% of GDP. There's not 3.9 trillion on the individual side, 700 billion on the corporate side. Some of these are expired provisions related to accelerated cost recovery, accelerated depreciation, and the deductibility R&D expenses. So they matter a lot for CapEx and in IP. So that's what needs to be extended now. Of course, our deficit picture has changed completely. We now have 6.5% of GDP deficits, and if we extend the law, basically by the end of Trump's term, have 7.5% of GDP deficits. So deficits are structurally trending higher, some from entitlements like Social Security and Medicare, and others from interest costs. Those are by far our biggest drivers of debt. So now, the cost of this law hasn't really worsened. It's worsened in nominal terms, but as a share of GDP, we're talking basically the same thing. 1.25% of GDP is a year kind of long run addition to the debt, or annual addition to the deficit. Of course, it's in some ways more expensive because the things that we did to reduce the cost of the law in the past were made permanent. So we don't get to use them again to defray the cost of the bill. So the question now for Republicans is, what new cuts do we need? Well, first of all, how long are we extending these tax cuts? Is this another temporary punt for 8 years? Are we making things permanent? Are we adding in new tax cuts? And how much do we need to offset the cost of this legislation? So Trump is an excellent salesman, and on the campaign trail, he was selling. He was pitching a lot of ideas. We should raise the SALT cap. We should give a above the line deduction for auto loans. We should 15% corporate rate for manufacturing, no tax on tips, no tax on overtime pay, no tax on Social Security. These were trillions and trillions of new promises. And Republicans in Congress don't intend to honor all of them. They're trying to figure out with the president now, sir, which of these do you really, really need? And they're going to find a way to give him those wins as inexpensively as possible. I would say of the things that Trump has talked about, tips is probably the policy he cares about most. On top of that, there will need to be a solution for SALT. So married filers right now have a $10,000 cap. It maybe goes to $20,000. And I think on top of that, Republicans will need to do something net new that is deemed positive for growth and investment in manufacturing. So you could do Trump's 15% corporate rate just for manufacturing, or something else. Like you could consider, just like we have a regime for full expensing of equipment, maybe they do that for structures or something like that. There's going to be a debate about it, but whatever they do, they're trying to do it as inexpensively as possible and probably on a temporary basis.
What's the tax on tips estimate in terms of what that's going to cost? And is that across all industries, or are they defining, are they segmenting certain industries where that would be allowed?
Yeah, the budgetary estimate for exempting it just from income tax, not payroll taxes or anything like that, is about maybe 120 billion over a decade. So relatively small as a tax policy, 12 billion a year. I think when it comes down to legislating it, all things in tax policy, there's a lot of gaming in the system happens, and they will be very focused on, and you'll probably at the end face an industry test. Like, is it for food service and entertainment, and maybe they'll put an income limit. If you earn over $75,000, you don't get an exemption. So,
am I going to have a plumber come to my house and fix a valve for $3 and then want a $800 tip?
They are going to try and structure the rules pretty aggressively to prevent things like that. But I should say we covered basically the cost side of the ledger. The offset side is by far the most important part. This will be the key to getting this bill done. And so the balance that needs to be struck now with this major reconciliation package is you have the immigration kind of hawks, or everyone is a hawk these days. Everyone is concerned about immigration. So you need border security in there. Yep. We didn't even talk about this. The defense hawks, they want 25 billion in funding for defense in there. The fiscal hawks, and then the SALT hawks. So you need all this stuff in there, and you need to control the deficit. So the way members think about this, they've got a, say, an 8 to 10 year extension of these tax cuts is somewhere between 4 and 4.7 trillion. Add on Trump's ideas for no tax on tips and SALT, we're now up to potentially 5 trillion or so. Add up something pro-growth, call it another 300 billion. You're at 5.3 trillion in cost, and they want to debate, do we have to pay for all of that or just a portion of it? We wrote a report just looking at all the kind of spending out there. I should say, spend maybe 55 trillion over the next decade, mandatory government spending. And so that excludes interest costs and discretionary spending. If you take out Social Security, Medicare, and veterans, which Trump doesn't want to touch, then there's 15 or so trillion. That's your total pool of savings to help offset the cost of this bill. Medicaid is 8 trillion of that. So, if you look at the House Budget Committee put together a 50-page list of all kind of budget offsets they're considering. We think, somewhere around 1.5 trillion is maybe the spending cuts, is maybe the sweet spot where you can have the Freedom Caucus and more conservative members look at that, say that is a substantial number that is meaningful spending restraint. And at the same time, moderate members like Susan Collins, Lisa Murkowski would be able to agree on each of those offsets. They're low-hanging fruit things that aren't too controversial. Of course, they'll be very difficult, but that's the sweet spot that will dictate whether this legislation passes or not. There's a ton of concern among Republicans about the deficit. So the key to the bill will be agreeing on those spending cuts. And that's basically what we're looking at right now, is tracking, what exactly are the spending cuts that they're looking at? Can they kind of keep Freedom Caucus members and while not upsetting moderate members? And where is Trump in all of this? He doesn't like to and be too detail oriented. He's not deciding a lot of these battles. That would be really helpful if he did. did adjudicate some of these differences between moderates and conservatives, and he's not doing it. But that's going to be the key to getting the bill done.
All right. So I have I guess, a final question I'll ask you. And this has all been fantastic. And Steve and I would love to bring you back in a few months when we get some more clarity, hopefully, on some of this. And I imagine investors are going to continue to struggle with it. So when you put all of this together, and all of this is an understatement, you think of deregulation as hopefully likely being pro-growth, tax policy, that's mostly just keeping the status quo, tariffs. Obviously, there's a lot of debate around tariffs, and so we'll have to react and see what happens there. And immigration, how do you guys think about the idea of what the fiscal impulse looks like? You're trying to put all this together, and maybe that's too broad of a way to think about it, but that's a question I was thinking about when you were talking all these competing forces.
So I'd say the very loose way to think about the fiscal impulse is just what is the primary deficit, or what is the deficit excluding interest costs? Of course, in a macro sense, we might assign different multipliers to tax policy versus spending policy that might affect investment incentives, marginal incentives to supply labor or investment differently. But just from an aggregate dollar sense, like, because it wasn't because, say, spending or tax policy expanded, it was just the deficit expanded during the pandemic. People had more money to spend. So the deficit excluding interest cost, when you add up all this stuff, make an assumption about China tariffs, extending the tax cuts, cutting spending, boosting defense spending, I think if you assume that there's no impact on economic growth, we will end up with a primary deficit that is just flat at 3% of GDP for the next few years. It may wobble up and down, in 20, 30 bips here and there, but that is effectively a fiscal impulse that is neutral. There's a debate among investors, which is, does the level or the change matter more? If the deficit is unchanged at 7% of GDP, that's an extraordinarily stimulative fiscal policy, but incrementally, it's not adding new dollars as a share of GDP. It shouldn't be driving output. So to me, when we look at all of these things, that's a fiscal impulse that is kind of zero. But add on top of that, is the composition of the deficit changing in a more pro-growth way? I'd argue yes. If you are cutting spending at a moment where our deficit is really large, in theory, cutting full spending or reforming social programs to make them more efficient and reallocating that to tax cuts that are more pro-growth, compositionally, the deficit should make growth stronger. And then add on top of that regulatory reform, and you have changes in consumer and business confidence that translates into a more pro-growth atmosphere. So to me, the kind of key residual is trade policy. We only import $400 billion a year from China. We have a $30 trillion economy. So if we ratchet up tariffs a lot, it may not have an enormous impact on GDP. It'll certainly matter. But to me, that's the kind of key variable that can change this fiscal trajectory. If Trump enacts his 10% universal tariff, that's a full percent of GDP tax increase on the economy. So that would really change our fiscal picture and the growth picture. So bottom line is, factor all this in, we kind of roughly neutral fiscal impulse. Compositionally, it's positive for growth. Add in deregulation, that's a positive. Knows what the bond market is going to say about persistent kind of 6-7% GDP deficits. I think rates matter a lot. And then trade policy. Those are the key uncertain factors for me.
Yeah, and for the market, the clear difference today compared to one clear difference between Trump's first term is just how much more rates matter. Obviously, they're higher. And after the inflation shock post-COVID, we've all become much more sensitized to interest rates and inflation as investors. And obviously, businesses and consumers have also become more tuned to price levels, which are likely to remain high and potentially go up if some of these policies end up being inflationary. So it's going to be, unlike right after COVID, where all those large increases in the deficit were extremely positive for equity markets. I think the reaction function of equity is going to be a bit different this year because of the sensitivity to the concern around inflation. In fact, Nick Timros had a good article this week where he basically pointed out the difference between today and 2018 was that nobody was raising prices back then, whereas today we've kind of we've changed the behavior. And I imagine if companies think they have an ability to raise prices, they're going to do it. And so it's just a very different behavioral backdrop than what we had. So it's going to be really interesting to see how all this evolves, and all the volatility and headline news risk that markets are going to have to contend with. So I wish you luck, and we'll try not to be a burden on you too much, but we're certainly going to be listening to everything you guys are writing about and saying.
Well, this was awesome. Thank you very much for having me.
Thanks for tuning in to today's episode of What's Next for Markets.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.